welcome to another edition of Trust Issues by Kepler Trust Intelligence. In today's episode, I'm joined by Thomas McMahon, Head of Investment Companies Research at Kepler, to talk about the BlackRock Smaller Companies Trust. So Thomas, let's jump straight in at the deep end. Why should investors consider investing in UK small caps?
Well, we love to have a moan about the state of the country, but we need to remember our economy remains one of the largest and most vibrant in the world. We've got a number of advantages: excellent education system, technical expertise, deep capital markets. And companies which make a success in the UK have a large market to grow into before expanding overseas. And this means that the UK is home to hundreds, if not thousands, of innovative, fast-growing businesses, and many of them are listed on the LSE. If you can find the right small caps, you can get in at the early stage of a company which can do 10 or 20 times your investment over time. A great example is Games Workshop, which some people may remember being just £200 million in market cap about 15 years ago and listed on the small cap indices. It's now a FTSE 100 company and has a market cap of, getting on for £7 billion, so about 33 times bigger. Some other examples: Fevertree had a market cap of about 150 million when it IPO'd, and that peaked at 4 billion in 21, so 27 times larger. Rightmove technically was at the top of the small cap market when it IPO'd, and it's grown over 10 times since then. And in the FTSE 100, there are other stocks like Halma, Diploma, which both have been small caps within this century. Now, these obviously are extreme examples of success, but they show that small caps can really deliver outstanding returns. And in general, they tend to deliver greater growth than large caps over the long term, thanks to greater earnings growth. This has been a period in the last few years where that hasn't really happened, and large caps have outperformed across the globe. Partly, I think that's to do with technology driving a lot of that earnings growth. But for any investor looking to maximize long-term growth, small caps are definitely a place they should be considering owning in their portfolio. And in fact, I would say because of the AI story and the success of global tech stocks since the pandemic, small caps are looking pretty cheap right now when you consider the growth on offer. So the returns in the coming years are potentially even higher than historic averages.
And moving on to the macro backdrop, despite concerns about the economic outlook in the UK, how are UK small cap companies actually performing? And are their share prices telling the same story?
There's definitely a big mismatch between the operational performance and the share price performance of a lot of small caps, which really underlines the point I was making about valuation. At the index level, earnings growth continues to be healthy and forecasts are for it to remain so. And I think the high level of M&A we're seeing from strategic buyers or peer companies from overseas, largely American, taking out UK companies, reflects the fact that the businesses aren't just cheap, but also good businesses. And other companies are happy to pay much more than the market value. We're going to talk about BlackRock Smaller Companies in a bit, so it makes sense to give a few examples from their recent results. Tatton Asset Management, XPS Pensions, IntegraFin, they're all portfolio holdings in BlackRock Smaller Companies, which have been performing extremely well, and yet their shares have slumped. It's probably pretty frustrating for shareholders in the short term, but I think this is really where the current opportunity lies.
And could you run us through the rationale for BlackRock Smaller Companies' recent merger with the Throgmorton Trust?
Sure, I think the main one is scale. Scale has become more important for investment trusts in recent years, and the transaction has seen BlackRock Smaller Companies add about £300 million in net assets, and it's now up to £900 million, bigger than all but one trust in the small cap sector, and almost twice the size of the third largest. This has a few advantages. It means that operational costs like management fees should have less of an impact on returns. And it means liquidity in the shares should be higher, potentially reducing trading costs for investors. I think now BlackRock Smaller Companies is an obvious first option for investors looking for a growth-focused UK small cap portfolio.
You mentioned fees earlier. Could you talk us through the changes for investors in terms of fees and also the triennial tender offer?
Well, the board thinks that the effect of the changes to the management fee will see BRSC shareholders enjoy the lowest ongoing charges of those companies in the ASC UK small cap sector that don't have a performance fee. The management fee will fall to a tiered structure of between 0.5 and 0.45, which they estimate will see the OCF fall to about 0.63%, all other things being equal. And that compares with BlackRock Smaller Companies' ongoing charges ratio of 0.8% in the previous financial year. BlackRock has also waived its fee for the first 6 months to help offset the costs of the transaction.
So I'd like to move on to the investment strategy next. What part of the small cap sector does BRSC target, and is there a particular style bias within that?
It's definitely a growth strategy. So the managers emphasize a company's growth potential when assessing it rather than the valuation, although of course all analysis has to be in reference to a fair price to some extent. In particular, Roland Arnold, the manager, looks for quality growth companies, which, bit of jargon, means those with repeatable and stable earnings, i.e. those which have a strong competitive position and are less likely to see their earnings rise and fall.
And what's the typical number of holdings in the portfolio, and what's the rationale behind this?
Roland tends to run a fairly diversified portfolio with around 80 holdings, and the largest ones aren't excessively sized. About half the positions make up about 75% of the portfolio, so it's tilted to the highest conviction holdings. Importantly, Roland isn't trying to take big sector bets, but he wants individual stock selections to drive returns. And he'll invest across the small cap index from the smaller end up to the larger end. And the larger stocks are more liquid, so they allow him to trade positions a bit more and be more flexible in how he runs the portfolio.
And to what extent does portfolio construction help to mitigate downside risk? And could you perhaps talk us through the sell discipline in terms of what triggers a reduction or an exit?
Well, Roland rarely sells on valuation grounds alone, which speaks to that growth emphasis, but rather when the fundamentals for a stock deteriorate or when sentiment shifts. Because he's looking to benefit from earnings growth, he's happy to run positions which are still performing. Although once a target weight's achieved, he trims back a strongly performing stock to that weight rather than let it dominate the portfolio. The benefit of this approach is it should limit the negative impact if any one company runs into trouble. And by taking a diversified approach, stock-specific issues should hopefully be the main source of downside risk, excluding market-wide issues, obviously.
I'd like to touch on income next. So BRSC is an AIC dividend hero. It's also moved to quarterly payments. So how does income perhaps sit alongside a growth-focused strategy?
One of the consequences of UK small caps being in the doldrums for a few years is they now offer a reasonably attractive yield. And earnings growth supports dividend growth, while falling valuations means that the yields have risen. At the time of speaking, the historic yield on the trust is about 3.5%, and this is all generated from a natural income, not paid from capital, unlike with many other investment trusts. The yield is lower than that available in gilts at the moment, but the key attraction in our view is the dividend growth, which is an important part of most income investment strategies.
And looking ahead, what are your thoughts on the outlook for UK small caps from here?
I think if you have a multi-year view, if you're a long-term investor, this is a really good time to get exposure to a growth market that's very out of favour and trading at undemanding valuations. Now, in the short term, the ongoing political instability in the UK and some difficult policies for business might make it hard to see an immediate change in sentiment. But the danger in waiting for the reason for a turnaround in sentiment to become visible is that everyone else will probably see it at the same time as you, and so the opportunity will disappear. Undervalued growth areas can really rocket away once the cloud of uncertainty lifts. So I think this is a good time to be looking at building a position in UK small caps.
And one final question for you. Why do you think investors should consider investing in BRSC?
I think due to its size, the diversification in its portfolio, the fact it can invest across the market from large cap to small cap, and it offers a combination of growth and income, it has all the credentials to be the first port of call for investors looking to access growth in UK small caps. It brings the expertise and research capabilities of BlackRock on a historically powerful growth market, which is out of favour and should repay research effort, and has strong credentials to be a part of a long-term growth portfolio. After the merger, it's now significantly lower cost weight to take exposure to and continues to benefit from the advantages of the investment trust structure. Specifically, can invest in the less liquid, smaller parts of the market, and can take on gearing to enhance longer-term returns.
And that's a perfect note, I think, on which to finish. So many thanks to Thomas for joining us today. You can visit BlackRock Smaller Companies website to find out more information about the trust. You'll also find our latest research note on the Kepler Trust Intelligence website. Thank you for listening, and we hope you join us again soon for another edition of Trust Issues. Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorised and regulated by the Financial Conduct Authority.